So, hey everyone, we're going to be doing question two of your assignment. So it reads, the 13F filings are reported by institutional investment managers to the SEC on a quarterly basis containing all US-related long equity positions. Select an equity fund manager of your choice and using their 13F filing and tabulate their portfolio returns. So don't pick a quant fund or an index fund. If you do this, it's going to be really difficult. There's a lot of stocks in them. It's kind of long and short. It's going to be too difficult. So just try and pick a nice and simple kind of long only fund. And it says, here you can access the latest 13F filings through the SEC Edgar website. This website's a little bit confusing to navigate. So I would recommend using the Whale Wisdom website. So if you open that link, it'll populate up here. And from that, you can go to research and then latest 13F filings. And you'll see here, there's a range of companies that have, reported recently. So that's what I have open in this tab over here. And then pick one, something that has, not too many, but not too little amount of stocks. So like 9 would be, great. But if it's, 10, 11, 12, that's also fine. So you can pick one of them. Over here, I've just opened one of the ones that I found. And as you can see, there's a range of stocks that it says that they hold in their portfolio. And the information that's relevant to us, obviously, is the stock type, as well as, the market value and what's the weight in the portfolio. So that's all stuff that we want to ultimately extract and put into an Excel so that we can answer the question. I think it's kind of question three of question two. So part three of question two, sorry. Awesome. But with that information, we can transport that into an Excel. You can download it, but I think you need to create an account. But otherwise, just kind of extract the relevant numbers that we'll need to actually answer the relevant questions, right? So if we come back to our Excel, we can look at question one. So question one says, once you have obtained the fund's stock picks and their weights, download the adjusted close prices from Yahoo Finance in monthly frequency and for the most recent 5 years. So ignoring dividends and calculate the monthly returns. And also feel free to use Bloomberg or another data provider, but it should be relatively straightforward on Yahoo Finance. You can just kind of specify that you want it to be monthly and you can then download and extract that data to Excel. And with that, let's have a look at question one. So question one, or part one of question two, says describe the risk and return portfolios for the selected stocks and make sure that you include analysis on the annualized mean and volatility of returns of each stock. And it says hint you can discuss the Sharpe ratio. So let's have a look at what this could look like. So here, just got a question up there, and then I've extracted some relevant data. So this is just pretty random. Haven't even specified the stock, but that's just for the sake of the example. Obviously, for yours, you'll need to specify the stock, and it will have to pertain to the portfolio that you've selected to look at. So here I've got our dates, so 5 years worth of dates. I've then got our stock price, so what's the price of the stock at the beginning of each month, and then our S&P 500 historical data as well. So what's the S&P opened or closed at the beginning of each month. And then here, we can calculate our monthly stock returns. So what I've done with this one is just our month opening for Feb divided by the January number and then -1, and that's obviously going to give you your monthly stock return. You can do that for all 5 years of data, and then similarly you can do that for the S&P 500 as well, which we'll need to obviously benchmark it against. So doing the exact same formula there. So the next month divided by the last month -1 gets our monthly return. And then over here, we've actually gone and calculated, the annualized mean and volatility of each portfolio. So what's our mean for the month? Well, that's just the average of the monthly return. And then the same thing for the S&P 500. For our standard deviation, we've done a similar thing, but we've used the ST-Dev formula, so the standard deviation formula in Excel, and then highlighted our 5 years of return so that we can actually calculate a standard deviation value for each of the stock and the S&P 500. And then down here, we've come and actually annualized those numbers. So how have we done that? Well, for the mean, it's 1 plus our average monthly return to the power of 12 -1. So just going from monthly to annualized return. And then we've done the exact same thing for the S&P 500. And then for the standard deviation, we've done square root of 12 multiplied by that standard deviation formula to get our annual standard deviation for both the stock or the list of stocks that we're looking at. In this case, I've just done one, for example, against the S&P 500. And then we've also calculated our Sharpe ratio as well. So our Sharpe ratio is calculated by our mean divided by our standard deviation. And obviously from that, we can see that it's different for both. But again, these are basically just random numbers as far as we're concerned for the question. So that's how we calculate our Sharpe ratio and our standard deviation. And that's kind of what we want to look at in question 1. So that's what we want to see basically through question 1. We want to see like the mean, standard deviation, what's the Sharpe ratio of each stock. And then something else that obviously we would expect is to see, possibly this plotted for the various stocks in your portfolio. So obviously here, when I've just looked at stock A, I've only given an example of one, but with your portfolio, like we spoke about, you'll have a range of stocks, and therefore we want to see that plotted. So, plot the mean, standard deviation. Where does that put it? Well, kind of here, you can see that like we're up over here when we look at where we are on the risk return scale, right? So that would obviously be filled in with all the other stocks that you've looked at in your portfolio as well. But that basically is what we want to see through question 1. Cool. All right, we'll move on to part 2 of question 2. So the question reads, estimate the betas and subsequently the cost of equity of the stocks. Which stock has the highest systematic risk? You can assume the S&P 500 index return is the market return and the risk-free rate is constant at 2% for simplicity. Further, if for whatever reason you are unable to source S&P index data, you can use the S&P 500 ETF instead. So I guess the idea of that is if you can't find S&P index data, which you should be able to, then you can just use the ETF, and the ETF just tracks the index, so there shouldn't be too much of a problem there. But anyway, let's get into question 2 and how we want to solve it. Obviously, we have this kind of key assumption that our annual risk-free rate is just 2%. So we can go and put that in all of these cells here. And obviously by that, we're just saying that the annual risk-free rate is 2%. Then we can go and calculate our monthly effective risk-free rate. We can either do 2% and just divide it by 12, or if we're assuming APR, or we can just go ahead and just kind of reverse our annualized formula, right? So 1 plus the 2% to the power of 1 on 12 minus 1, right? And that gets us to our effective monthly risk-free rate. From there, we can actually calculate our MRP. So what's our market risk premium? Well, our market risk premium is just the monthly S&P 500 return minus the monthly risk-free rate return. And as we can see, we're just doing, E17 minus G17, and that's going to give us these numbers here down the right-hand side. And ultimately, I guess, what are we trying to solve for with this? Well, we're trying to estimate beta so that we can then go and calculate the cost of equity for our various stocks. And up here, I've just put the cost of equity formula. So our risk-free rate plus beta multiplied by the return of the market minus the risk-free rate, which is the market risk premium, right? And that's exactly what we've gone and calculated over here. So we can start with this market risk premium part. And here we've got that here for the months. We can go and take the average to get to our average monthly market risk premium, which we can see is 0.52%. And then here we can go and convert it to an annual market risk premium, obviously by just doing 1 plus the monthly to the power of 12 minus 1. So as we can see, we've got our annual MRP of 6.39%. And then over here, we actually want to estimate beta. So how do we want to do that? Well, we want to estimate what's the return of stock less the risk-free rate, and then what's the return of the S&P 500 or the index minus the risk-free rate. So here we're comparing apples to apples, I guess, if you will, in the sense that we're looking at the return of the stock relative to the return of the market. And then we can use that to calculate beta. So how are we going to do that? We'll do a regression. So going across to data and then data analysis, you'll have to install the data analysis tool pack. But we should have already done that earlier in the semester in one of the tutorials. Clicking OK. We can then insert our relevant cells. So we want the Y input to be the stock return minus the risk-free rate. So this column here. And we want the X range to be the S&P 500 minus the risk-free rate, right? And then we also want to tick constant is 0, and we can output to a new worksheet if we like. Otherwise, you can output to a range and you can select a range. But for simplicity's sake, we'll just output to a new worksheet. and we'll see what that looks like. So if we hit OK, we then get all of our regression statistics and outputs, and we can see here that our beta is 1.33. And then using that, if we go back to the question, we can go and input that here and then actually go and calculate our cost of equity. And obviously our cost of equity, like the formula states, it's the risk-free rate plus the beta multiplied by the MRP, right? And up there and then up here, we can see that it's 10.5%. So for this given stock, again, I'm using the same data that I calculated with in question 1. So looking at that, stock A, which I just pulled some random data from, and you'll have to do this for each of the stocks that are in the portfolio. So obviously our MRP will stay constant because that's relevant to the market part of it, but then we'll have to estimate an individual beta for each stock. And like I said, we do that by looking at the return of stock A minus the risk-free rate relative to the return of the S&P 500 minus the risk-free rate. So hopefully that makes sense. Awesome. So we'll now move on to question 3, or part 3 of question 2, I should say. And it says tabulate the covariance and correlation matrix in Excel and subsequently work out the fund's total portfolio risk. Awesome. So what I've got here is, again, just a mock layout, and your numbers won't look the exact same, and that's completely fine. And what I've got down is the monthly historical returns of a stock portfolio with 7 different stocks in it. So that's what I picked. Again, yours could be larger if you chose a portfolio with slightly more stocks in it. But again, this stock A column should look familiar. These are the kind of the average returns that we've been working with across the whole time. But then obviously these are all new because I've just populated them in now, but those will be seen in your questions 1 and 2, given that you'll be doing portfolios with more than one stock. So here we've just got our average monthly stock returns in each of these columns for the 5 years that we've looked at. And then over here, we're going to do what the question asks us, and that is to calculate the covariance and correlation matrices in Excel. So how are we going to do that? We've obviously got our stocks, so I've just called them stock A. Yours will be, Tesla, Nvidia, or whatever stocks in the portfolio are. And you can see that if we look at stock A and stock A, it's the covar formula, so covariance between stock A and stock A, right? And then for stock B, it's going to be between stock A and stock B because that's the column that we're looking at. So stock A, B, A, C, and again, so I've got it locked in my formula on the stock A column, and then it's kind of just moving across as I've dragged it across into the stock C, and then it will go to stock D here and so on and so forth. And then to go down, we're going to do the same thing. So we're looking at stock B now, covariance with stock A. And then here it's B and B. And then here, as you can guess, it's B and C. So hopefully that makes sense, but that's how you want to lay out your covariance matrix, and that's how you solve for it. In terms of our correlation matrix, we're now going to look at the correl function, so correlation function in Excel between our various different stocks. So if we look at the correlation between stock A and stock A, we would obviously expect that it's 1. So that's why you get 1 running on a diagonal here, because here we're looking at B and B and C and so on and so forth. But again, similar to what we did above, it's actually the exact same kind of way of writing it. You just use the correl function instead of the covar function. But again, we're looking at the correlation between stock A and stock B, and here A and C. So you kind of get the point, and that's how we solve for our correlation and covariance matrices. In terms of what we can then use that for, we can then go and subsequently work out the portfolio's risk. So looking firstly at variance. So here's how we solve for variance. We're using this kind of pretty large formula, using the multiply function with the transpose function to go and multiply our stock weights by that large covariance matrix, so we can actually solve for the variance in our portfolio. So again, typing in that formula will get us our variance. For our standard deviation, we can just do the square root of variance. That's obviously our formula for standard deviation if we know variance. And then here we can also calculate our Sharpe ratio, which is just our portfolio return by our standard deviation. And if we look at how we calculate our portfolio return, we can use this multiply function by our expected return of the stock per annum. And if you want to do the transpose with the multiply, you just do the at sign in front of it. And obviously, in terms of where I've gotten these expected returns from, I've just gone and pulled, 1 plus the average of the monthly expected returns. Obviously, this is our monthly expected returns that I've pulled across, to the power of 12 minus 1 gives us our annual expected return of each stock across the 5-year period. And that's how we ultimately calculate our portfolio return, combined with our portfolio risk stuff, correlation matrix, and the covariance matrix, which we'll need to use to solve for obviously these things in part 3 of question 2. Now we're going to look at doing part 4 of question 2, so our final part. And the question reads, pretend 50% of the fund needs to be liquidated because a large client has redeemed her capital. Which stocks would you sell if you wanted to use this opportunity to reduce your total portfolio risk? Show the portfolio weights, dollar values, and portfolio risk before and after redemption. Also show your redemption trades, and then it says hint, you can assume the new portfolio remains the same as your original portfolio return, right? So let's have a look at how we want to do this. So over here, I've got our original portfolio. So these are our original weights. Everything that we've seen in the past couple of questions, nothing's changed, and the same amount of stocks. And again, you might have different weights of different stocks, and that's okay, because we've picked different reference portfolios originally from Whale Wisdom. And again, that's how we will get our total value amounts and stock, because we pulled all of this from Whale Wisdom at the beginning. But let's have a look, what we actually want to solve for to try and get, lower risk in our portfolio. So if we head over to the solver tool, this is how we're going to use to solve for stuff. And I've already got this all set up. So what's our objective? Well, our objective is this F19 cell. So we want to make our variance minimum. So we're trying to lower our variance. We're then going to be doing this by changing variable cells N28 to N34, which is our weights. So we're changing our weights. And then we also want to add some subject constraints. So what do we want to do? Well, F23 is our portfolio return, and we want that to be the same, like it says in the question. So we've set F23 to be equal to 1.29%, which is the same as our original portfolio that I've just screen clipped here. Additionally, our N28 to N34, which is just the cells in my sheet, that's the new weights column here. And we want our new weights to be greater than or equal to 0. So we don't want to be shorting anything. And we want the minimum weight to be 0 or the maximum to be 100. And then the final thing is that we want our total sum of the weights, which is this 100% here, to be equal to 100%. We don't want it to be 0 or 10. We want it to be equal to 100. So once you've got that set up, you can then hit solve. I've already done it, which is why my numbers look different already. But once you hit solve, it'll solve for the new portfolio weights. And then, as you can see, we've got these new weights here. So originally we had 11. Now we've got 7. This has come up a bit. This has gone down to 0. This has come up to 24 from 15. This stock E has come up slightly. F has come up slightly as well, and so has G, right? And then what else can we see? Well, we can see that our new value is halved because I've got it set up to halve it correctly. But if we come over to our portfolio statistics, we can see, what the new weights have actually meant. So like I said, we've solved for the new weights, and now we can solve for our new portfolio statistics. So how do we do that? Well, the same way as we did it before. We're looking at our covariance matrix multiplied by our new weights to go and get our new portfolio variance. And we see that our variance is reduced from 0.67 to 0.58. Likewise, our standard deviation has also reduced, and our Sharpe ratio has increased, but also noting that our portfolio returns have stayed the same. And again, we've calculated that the exact same way as before. So our new weights multiplied by our expected return of each stock gives us our portfolio return. So nothing too new in terms of how we calculate that. But obviously the new thing in this question being that we're using solver to calculate for our new optimal weights. And then in terms of, show you your redemptions before and after the trades, I'll let you guys figure out how you want to display this accurately to show that you've increased the weights of certain stocks and decreased the weights in other ones.